Welcome to Shelf Help. Today we're speaking with, I would say, two of the most sought after early stage CPG investors in the space these days, Robb and Adam Spriggs. Adam and Chris built the Angel Group, well-known syndicate that invested early in brands like Siete, Poppi, Bachan's, just to name a few. More recently, they launched Supernatural Ventures. It's an early stage VC fund focused on consumer as well. So really excited to get into it. Yeah, first off, just for the listeners that aren't as familiar, maybe Adam, if you want to just give us kind of quick lay of land in terms of original vision for the Angel Group, what the org looks like today, a few portfolio highlights, and then Chris, I'll let you kind of talk about Supernatural.
Yeah, let's dig right in. And thanks for having us, Adam. You're a friend and member of the group, of course. So it's good to be here with you.
Yeah.
So original vision from the Angel Group, I could come at this really from a couple different paths. I think for the industry, I've been in the industry for 20 years. You see a lot of things kind of come and go. One thing that I was noticing about starting probably about 6, 7, 8 years ago was that there is a significant funding gap between founders who are raising money from friends and family to when they can actually be credible businesses in the eyes of venture capitalists, like institutional investors. So, that are typically looking for brands that are doing $1 million or more in revenue. And there's a big funding gap between the friends and family who will back you no matter what, and then the institutional capitals who want to see you kind of jump over certain hurdles before they get involved. And I always felt like the most kind of qualified investor to come in and help fill that gap were industry people themselves, people who work in the industry day to day in different capacities, who might invest their money in the stock market. They might invest their money in sports gambling or private businesses or whatever, real estate. And my thinking was always like, why don't you put your knowledge, your expertise to work and invest in the early stage landscape of CPG. And so that was part of the vision for getting Angel Group started, was fill that funding gap, bring industry people together. And then selfishly, the second part was that I had wanted to start getting involved in angel investing personally. No finance background, no investment track record, nothing in my family, like just starting cold from industry experience. But primarily as a marketer, I spent my entire career as a marketer, really. And I always felt like I was ill-equipped to evaluate how to invest in these companies on my own. I thought, working alongside other smart industry people who came from sales or finance or operations, we could do a better job communally diligencing these companies and kind of deciding on which brands we felt like we had the most conviction behind. And that was really the genesis of the Angel Group, was kind of building out from there.
Cool, that's great. Yeah, Chris, and then you guys more recently launched Supernatural. I'm kind of curious, tell me a bit about that, how it complements the Angel Group and maybe what kind of the vision is, what the firm looks like, 5 years from now in an ideal world.
Yeah. Well, I think that, Adam and I were building the Angel Group for years, before thinking about doing the fund. And I think it was really pretty organic evolution, frankly, because, I think the biggest, driver was when you're talking with brands and thinking, when you're kind of building your own conviction, which is how we've always selected brands for the group. It's really been, Adam and myself, as two industry hacks, not investors, people that just, have been 20 years in the industry and grown up in grocery retail or marketing and branding. And like, that's a lot of what we've relied on is instinct. And the group was to bring in domain expertise to round out our diligence, thinking, and to kind of pressure tests, when we're looking at deals. We felt like we had a really good system for evaluating, for value add, for deal flow, a lot of factors. And the one thing that we were missing was the ability to, in conversations with founders, say, hey, we really, really believe in this deal. We've kind of done the work. We're going to bring it to the group, which is an opt-in network, is very different than saying, we're going to put in, 500,000 and bring you to the group. And we felt like that was just a natural evolution of the platform and the ecosystem that we wanted to build. And also we wanted, Adam and I wanted to be full-time investors, and so I think there's an element where, bringing in some more passive resources, right? Like, the Angel Group is full of folks like yourself who are in the industry and very active and want to be participants in the process, but not every investor has time or wants to do that. So it was kind of a way to bring in some more resources into the industry and into this early stage thesis that we have kind of built our identity around. So it's been a lot of fun. I think a lot of people we're still in the midst of kind of fundraising, but we did our first close in June. We've executed our first 5 deals and got it out of the gate, and it feels really fun to just it's been a lot of learning for us. Standing up as a fund is obviously a heavy lift, but it's been enjoyable. I think a lot of people talk about the fundraising process and how much of a bear it is and how hard it is, and it's a lot of time, it's a lot of work. For me, it's been one of the most exciting, exhilarating times in my life, just meeting so many different types of people and sharing your passion and conviction for what we do every day. So yeah, it's been a fun evolution, and frankly, to do it with this guy who I have so much respect for, and it's been a dream come true.
That's awesome. That's great. I mean, you guys clearly sit at kind of the nexus of the universe when it comes to CPG in a lot of ways. So yeah, Chris, I'll let you take this one on that, and you can kind of build on it. How would you kind of describe the current landscape of early stage CPG today?
Well, it's a really exciting time to deploy capital. Probably the most exciting time that I've ever seen. And I've been, in the industry for a long time. But I think, having started brands myself in the growth era, I'll call it, pre-COVID, is a lot of kind of growth at all costs in the mentality. And I know this is stuff that we all talk about all the time, but I think really you see a lot of people on the sidelines, a lot of people waiting for others to make a move, and I think one thing that we think a lot about is, if you're willing to make the move first, if you're willing to take the swing, that's a lot of what venture capital is about. And I think that there's been some of that in terms of the venture that exists in this space that has maybe exited stage left. I also think you just look at the numbers. I mean, venture capital is down in early stage for CPG 60% since 2021. It's pretty significant, right? So there's a lot of that white space that we love is also a bigger white space today than it was a few years ago. But I also think that one of the things that we pride ourselves on, and you've experienced this, whether it's Jesse and Ben's or AO or a Painterland, I mean, we like to come in early. We like to, and it's kind of how we positioned our fund and positioned the group is just when you have conviction, you got to take the risk. That's a lot of what venture is about. And we have a lot of confidence because we've done that before. We've invested in multiple brands that have become pretty successful at the pre-revenue stage, So I don't see a lot of people out there kind of willing to take that type of risk. And that's something that we really enjoy doing. And
Totally.
It's, when you see it, and it's a lot operating on instinct at that point, but it's something that we, have always kind of seen as part of, what we want to do in this industry.
Yeah. Adam, anything you want to add to that?
No, not much. I think the innovation is relentless. That's great. That's, never ceases to amaze me. New founders stepping into the arena, it's, unpredictable in many ways in terms of just, how a trend is going to manifest across different categories. So there's always the element of surprise. It makes it fun and interesting. There's always been the social dynamic, right? Food is fun. It's personal. It's tangible, kind of versus other sectors you can invest in. I think more people are realizing that too. I think CPG is becoming popular again with, I guess you'd say kind of like outside money, outside interests. They see the Simple Mills transaction or the Poppi or Siete deals and brings some people back into the mix, which I think is a good thing. It's just, that's probably what took us off the rails there for about 5 years or, 10 years from 2000, 10 to 2020 or so, where it was just a lot of tourists, coming by and, investing in things like plant-based and gluten-free. And, more recently it's been like non-alc. It's just kind of over-indexing on these kind of fleeting trends or these slow to grow or slow to develop trends. So there's always something new to get into. And I think that's the best part about CPG.
For sure. Totally. What categories, based on all the investors you talked to, are the one most excited about right now? And on the other side, are there any that feel like undervalued or ones that are not getting as much attention as maybe they should, that feel like they have some of like the most room to run?
Yeah. Chris, you should talk about commodity goods.
Well, I think You look at like non-alc and plant-based are good things to look at. And again, I feel like I'm preaching, a little bit to what people understand at this point. But, you could see this a few years ago happening where it's like so much money is coming into these categories because when you just look at the trends, okay, people are drinking less alcohol, people are eating less meat, et cetera, et cetera. But it's like, there's no infrastructure yet in retail. There's no dedicated feet. There's no planograms built. There's like, it's, for me, I'm like, this is crazy. And also there's just not the demand. And, this is something that, Adam really well, but like one thing that we talk about, like I live in Saginaw, Michigan, Adam lives in Toledo. So we're, you're down in Minnesota. So you understand this probably more than most, but there's a lot of the innovation comes out of metros on the coasts, or in, particular cities, like even like in Austin or Boulder. And I think it's, which is great. A lot of it is looking through a different lens than I think we are day to day when we're shopping at Kroger or Meijer, or, just kind of looking more through the lens of the mainstream consumer, and most Americans. And I think that we tend to be more bullish on innovation within bigger categories that exist versus, innovation in categories that are new. And sometimes absolutely it's worth and warranted to take a swing on something that is disruptive and really just has that potential to break through the wall. And that's part of venture, absolutely. But I think that we just see a big opportunity for, I would call it like back to the future a little bit, like grew up in the natural products industry. So I've kind of seen this my whole life, but at the end of the day, better for you as a concept is always going to be centered around keeping it really simple. So things like, higher quality protein or, higher quality dairy or, things like that are going to be, big categories that they just, or, French fries, frozen French fries, right? I remember taking a lot of heat when we first brought this to the table. It's never going to work. Frozen French fries, how big could that be, right? And I think it's just like, yeah, but most Americans, they want a better option. They're going to eat French fries probably multiple times a week, and they want a better version, And so I think it's just you can't overlook the power of existing behavior that is within a big category and putting a spin on it that's relevant and current and going to be current, for the next several years, because ultimately that's what's pretty valuable to strategics.
Totally. Yeah, that all makes a lot of sense. Diving into like the weeds a bit more, I read a few small angel checks here and there, primarily through you guys, through the angel group. And I think kind of some of the things that are top of mind for me, I think are probably not uncommon, is especially those earlier stages. Obviously, the founder and the team product obviously has to taste amazing, and just is the overall experience really good. Unit economics have to be there, velocity's there. And then, you kind of touch on it a bit going after these bigger categories, but in similar ways, like, is it clear where the brand sits on the shelf if the buyer doesn't really know what category this is in? Might be a little more challenging. What does your guys' general kind of checklist look like? And what does a fundable early stage brand look like to you guys in 2025?
Yeah, I'm glad you ticked off a lot of the items that are just kind of checkbook items, right? That are checkbox items that, I think any investor would come on and talk about. Some of the lesser talked about, I think, criteria or considerations is, one I would say is just, the founder themselves, outside of just kind of owning and commanding their business. So much, I was thinking back on this yesterday. Chris and I are always on calls with founders, right? And oftentimes together. Maddie Serviente on our team is also alongside of us for many of these calls. And it's like when we regroup after a call with the founder, I think a lot of times we want to, dig into the business itself, the product concept, its potential. This is a debrief session. But ultimately, what we end up talking a lot about too is the founder, what we thought of them. And it's not necessarily like a judgment about them so much as it is like, you notice when we're talking about, I really like that guy, or I really like that girl, or I really want to see her win, right? Or I just felt she was really warm and welcoming and, open. I think one thing, some of your audience are founders raising money for their CPG brand, to go in and present yourself authentically, I think goes a long way. Being willing to talk about yourself personally, you don't have to go too far, but I mean, just to open up a little bit. It's interesting how much that, I don't know, just puts points on the board right away with between anybody, right? It's just to be able to connect on a human level. And I would say that, almost every day we're meeting really, really good people who are joining our group, who are investing in our fund, who are founders we want to get behind. But we will go to like extra lengths to see, even if we're not investing in a company, if we connect with a founder on a personal level, and Chris can say this because he's got so many people we've never invested in who are texting with him daily, working with Chris and, utilizing his network and brain power and resources, to advance their companies. So I think that that's a big piece, is just really feeling like you can get a good connection with the founder. The other thing I would say is the product concept itself goes a long way with us, right? So in almost every scenario, before we do an intro call, we're going to order product to our homes with the founder of the company that we're going to be talking with, and we'll all sound it out. We have Friday calls where we've all opened our bags, our boxes of food products, and we're sitting around and talking about what we thought of it and how quickly we're consuming through it and what our family members think of it. So seeing something that, you're just mentally thinking about going back down to the pantry, grabbing another bag, eating through the case, you send it over to a friend's house, they've eaten it, like that's a really good signal for us. And oftentimes it's a substitute for market data because these brands aren't in market yet. So you're leaning a lot off of your own personal experiences with the products in the household. So if you can make a big impression with the product, create a memorable product experience, that goes a long way.
Yeah. Chris, I'm more like the quantitative side for brands that have been in market, at least to a certain extent. What are the must-have metrics for you guys?
Yeah. Well, one thing I would say just quickly is, everything that Adam said on the founders is right on. The home test, the kitchen test, like the product has to be undeniably good, and I think a lot of times people overlook, oh, it's 95%, it's good enough, it's not 100%. If you're not 100%, like just wait until you are, because the product just has to be undeniable. And I'd say the same thing for the brand. I think like overwhelming majority of the time that's overlooked, or hey, we're going to get this off the ground and we'll invest in the brand at some point. I really, really look for people that spend the time to get the brand positioning right and to really make that investment. It's a hefty investment, but it's one of the best. If you really believe in what you're doing, it's the best investment you can make. And so a lot of times we'll find stuff that we like. It passes the founder test, passes the kitchen test. The product is exceptional, except, it feels undeniable. Sometimes the brand we don't think is there, a lot of times that will be kind of a piece. And so a lot of times we're willing to kind of do the work, to help with that brand and positioning. And I think that not often do you see people that have gone all the way on the brand front. But part of early stage investing is understanding that not everything's going to be perfect. But if the product and the concept is undeniable, it's worth putting some elbow grease in to work on the other things that are manageable.
Yeah.
And so that's something that we've done multiple times in terms of the metrics and indicators, for people that are out in market. And this is something I always, coach is like, start with your own region, start with your own premium accounts. You're going to be at an inefficient phase if you're early. And so go to where customers are going to be less price sensitive out of the gate. Just makes sense while you're in your inefficient phase. Leverage regional distribution or go direct if you can, like whatever the situation is. But retail is an indicator that matters to us. If it's going to be in market, that's what I care more about than D2C. Because D2C is a little bit unfair in the sense that you're kind of marketing directly through ad campaigns or whatever it may be, social influence. It's a little bit unfair versus retail, which is going to be much more organic velocity. Like if you're in planogram, you're not on promo, that's like a true test of velocity and how your packaging is working, how your concept is working, how you're standing out against the category. That's just real data you can look at. And so I think a lot of times too, we'll see in pitch decks, inflated data that's built on promo or demo and things like that. So like one of the things I really look for is, okay, what's the non-promo period look like, over the course of, ideally, several weeks or more. And I want to see that this is resonating, at a premium price point in a premium market that is less price sensitive. I want to see that you're working in that organic, premium price point and beating category on dollars. Ideally, that's a really good indicator, regardless of how, the worst metric that people market to investors is door count, door count is not like, sometimes if, we're in 2,500 or 5,000 doors, I'm like, I don't, why is your revenue not crazy higher
Right.
then? Right. So
Almost more concerning. Right. Yeah.
I think that's the biggest mistake that founders make is marketing door count. Or another thing that I see is marketing, retailers in their timeline that they don't have real commitments from. That's a real red flag or a frustration for me. It's like, okay, if you're putting the retailer logo on there, I'm assuming that you've got a commitment. If you don't have that commitment, I think it's a bad look. So it's if you market it as such, where it's like, okay, this would be our ideal, outcome, and it's transparent that way. But I think a lot of times you're seeing, just Adam said the word authentic, and I think that's right. Just be where you are. Then I don't have to uncover everything. It's a lot, and it helps build trust. But it's that organic velocity, that kind of that retail data. That's going to be, if you're in market, that's going to be the data I care about.
Yeah. When it comes to COGS margins and also like sales forecasting, what are some of the most common ways that you see founders and operators get this process wrong?
Well, so let's say you start in an Erewhon, right? And you're gonna, you've got a good brand, you've got a good shelf presence. There's an Erewhon is kind of already immediately gamed in your favor because there's less assortment, there's less choice, and so your velocities are always going to be like 2 times higher at Erewhon than they're going to be when you go to a Whole Foods or a Sprouts, right? And so you could be pumping your numbers based off of this rate of sale that you're experiencing in a premium account or an independent account, similar to an Erewhon, and projecting that out across, I don't know, 250 Whole Foods stores. And the fact of the matter is that Whole Foods in general is just going to be a step down from what you're seeing in some of these other premium specialty independent accounts. And there's also going to be some real laggards within those, 200 Whole Foods stores, right? So they're not all going to perform the same. So I think it's, I always prefer for founders to just take, especially in their early going, I think there's a lot more to be said for just being conservative in your estimations. And also even when you're going to get to your price breaks, and your COGS formulations, your margin breakdowns, like I've done this. I've looked through, maybe I could look at the, 12, 15 decks, from a year ago, any random sample of them. 80% of those companies aren't going to be where they said they were in margin, a year later, and they're not going to be where they were in door count or revenue, especially.
Yeah.
So I think, and investors, if they don't remember that, they can look back on it very easily. And I always ask founders, who are actually like a series or a seed stage, like, what was your promise to your investors and, your pre-seed investors, and are you there today? So I think it's just good to be conservative with your numbers and not get too far out ahead of yourself.
Yeah. That makes a lot of sense. Well, yeah, to follow up on that, just kind of a bit of a rapid fire round, just like a few sentences on each of these. Chris, I'll let you take the first one. You guys invested in Siete pretty early. That obviously was a very successful exit. What did you guys see and kind of what gave you conviction?
Well,
Yeah, right time, right place, Adam. That's about the extent of it. I
mhm.
think I don't know if anybody who came in who was invested in the brand when we were would have predicted what was going to happen. I just saw two founders, and this was, it wasn't even a voluntary choice, right? It was part of a program that I was involved with, where you're effectively a mentor to a number of different brands. Siete happened to be one of them, but had a good relationship with Miguel and Veronica, was rooting for them, saw that the Mexican food or Latin or Hispanic food category was, in sore need of refreshment, saw a brand that I thought could do it, but I had no idea where it was going to go from these grain-free tortillas into all these different snack categories. So I would chalk that one up to right time, right place.
Yeah, I think the brand was always exceptional. Like, to my point around brand, back in, I think it was 2016, Expo. I remember their booth in the Hilton Ballroom, I think it was, when they were doing booths back in that hotel. But you could just tell, like, it was an iconic brand that was built. I thought it was really exceptional. And I think it was a time of grain free. It was a time for like rising of grain free. And it was also a rise of ethnic, and just premium ethnic. And also it was also kind of a rise of gluten free too. So there was a lot of boxes being checked, in that time frame, for a brand like that. And then you had a great a great team, right? Like it was and it was that is a little unconventional, like having that family, the family, side of that business as well. But you could just tell there was a lot of passion, in
Totally.
that pursuit in the early days,
Yeah,
as I recall.
Chris, same question for Poppy. What'd you guys see on that one that early on?
Well, as somebody who had started a apple cider vinegar beverage in 2013, that didn't work. I think I knew that was a polarizing ingredient. I think Poppy, and this was true for Olipop at the time as well, but I think we're in what I remember a lot about that era was like people did not want sugar in their beverage, and I think that was part of the challenge with the product I had built, had 19 grams of sugar. It tasted really great. And you needed to balance that. But I feel like, I think that there was a lot of brands coming after that space, that kind of functional, soda, whatever you want to call it. But I think that that again, speaking to brand, and I think Kavu did a tremendous job with this, but really kind of moving into soda, was just a big unlock for the time, I remember talking to other people, George Bryson comes to mind. He had a brand called Wild Poppy, and I think he had tried he was looking at a soda development, and there were rumblings on a lot of brands, but again, it just comes down to that kind of the formula, like how does the product taste? Does it hit the mark? And a lot of it, so much of it's just positioning in brand, I think, and
Yeah.
and having a product that delivers.
Yeah.
They were also really smart to stay away from classic soda flavors in the beginning. So they were, cherry lime and strawberry and grape and citrus, and, they had an orange skew. So consumers weren't asking for Olipop to match, or Poppy, I should say, to match the flavor profile of their Coke or Pepsi or
Right.
root beer, or diet soda. So,
Yeah, that's smart.
yeah, I thought that was a smart move.
I'm not sure which one you guys are closer to this one, but how about Bachan, which I know that's been one that hasn't exited yet, but I know that's one that's coming.
Well, yeah. I mean, I think was pretty close to that one from the very beginning. And I think the biggest thing for me is like the first time I tried the product, I was hooked. I thought it was a phenomenal product. And I thought if we could commercialize this, that people would really buy it. And I think, again, I remember standing in the grocery store in the early days with Justin, looking at the shelf and seeing, soy vey, which I actually liked. I grew up eating soy vey as a natural food kid. But it was also kind of a acquired thing, it's like a teriyaki sauce with sesame seeds in it. It's kind of a weird one. And I didn't think it was really mainstream. And then you had a lot of other people playing in the space and private label and, private label type brands. And so it just felt like teriyaki was a flavor profile that was really wide open. And, at the time we were looking at brands like Cholula that were exiting or, entering into pretty big deals with crazy multiples. And we're like, this sauce category is interesting because, there's a lot of interest in condiments, you could see that rise coming. And, and nobody had really kind of taken a premium at that point. Really, I think it was us and Truff that were really kind of coming after that ultra premium when we first launched, right? Which when we first launched, it was $12.99, which was like a conscious choice. And I remember, buyers telling us that it was never going to work, but I remember just having, Justin having a lot of conviction in the idea that if we used fresh ingredients and we cold fill it and we didn't water it down and we actually made the product that tasted like the one that his grandma created the recipe for and like the one that he made in his kitchen, that if we could just bring that to market in a package that was undeniably attractive and uncompromising in terms of the sauce itself, that it might work, and we had conviction in trying that at the very least. And I've learned more through that experience of watching that work than on any other deal. But, we put that on the shelf with some local grocery stores and we were selling, almost 300 units in a weekend per store, on that original SKU. And, it was outrageous. And so I think that when you kind of, I think a lot of it's timing, Adam, like I think it's a lot of it, now I think I don't know how many people are in the same squeeze bottle that we that we were, using back then. And but it was just, it really was, it was a lot about the product itself, and just looking at the category and saying, hey, there's nobody really coming after this space. It seems like an opportunity. And then positioning, right? We created a category in Japanese barbecue sauce that didn't exist, right? And I think that was also a very conscious choice to not call it teriyaki, but to call it something that, and the reason why that's powerful is not everybody knows what to do with teriyaki sauce, but everybody in America knows what to do with barbecue sauce. So it drove occasion, an understanding of the occasion. I can marinate, I can grill, I can do this. And that's been a lot of the success is really, I think just, you can use this in a lot of different ways. And that hadn't been done yet really in that category.
Yeah. Yeah, those are all really helpful. Great kind of look behind the scenes. Shifting gears a little bit, talking about the founder and founder team. What are some of the kind of key things you look for in any red flags that you've kind of learned over time that if I see this kind of red flag, this is probably going to be a no for me?
Well, I'll get it started. I think it's interesting. Most times that we're engaging CPG brands, it's a one person or two person team. It's the founder and their wife, or a founder and their college friend. It's usually post our fundraising round where they're going out and starting to hire talent. I think overall, our theory, I don't know if this is exactly universal, but it's just to be, I think, very cautious about adding headcount to a team too early. I think certainly can't blame a founder for wanting to bring in some warm bodies to come in and take some of the load off, right? But I think outsourcing or kind of shifting critical functions of the business to an actual full-time staff member too early can be detrimental to a company that, at the time we're engaged in, hasn't raised a ton of money yet. Yeah, I don't know, Chris, what would you add to that?
I mean, I think that's one of the biggest things is really just like when you're looking for that, you have to be a little wild to want to be an entrepreneur in this space. Like you've got to really be more than 100% all in. Like you have to, I think it's or you have to have some unfair advantage if it's not that. But like you've got to really be, willing to work 80 hours to avoid working 40 kind of mentality. And so I think that's a lot of what you look for. I also just think like looking for, it's really easy to make expensive mistakes in this business. Like if making mistakes in this business is expensive, I should say. And so in the early stage in particular, I think the way that you can mitigate a lot of risk, especially for founders that maybe don't have experience in this industry, is about being open to understanding, like learning from folks who have done it before. And so I think that one of the biggest things I look for is somebody that's receptive to feedback and wants to have that open dialogue. Like Adam said, is authentic. Part of being authentic is understanding what you don't know and not trying to act like you do know to look good. Like that's the biggest thing I look for is if people are trying to posture to save face, like that's the worst. That's the biggest red flag, right? I think it's like that humility. I think a lot about ego, right? Because I'd be easy to say ego is not, attractive at all. And it's not, especially if you're building a friend, I would say something I don't look for. But I think you need a little bit of ego, in terms of what you're doing, just to have the conviction that warrants that more than 100% all in. I'm not saying that always needs to exist, but I think that I've seen, areas where it's not bad to have a little edge to you as well, as long as it's not over the top, as long as it's still coupled with humility, and some other factors that are important. And I think also just how you treat people, how you, like when you're talking about team dynamic, it's really, leadership is all about, getting in the trenches, rolling up your sleeves and being the first one in the office and setting the example and not asking people to do things that you're not willing to do yourself.
When you guys see a founder when they're fairly early, maybe they've gotten some really like early signs of product market fit. They got really strong taste. Like they've come up with a great product. The brand is dialed in, but they have pretty limited experience. They've never done anything in CPG before. Will you guys make a bet
Well, Justin didn't come from CPG, with Bachan's,
Good example. Yeah.
Stephen and Allison, Miguel and Veronica at Siete. If you look at some of the other companies that, have done really well, I guess Janet Gould's had some experience in CPG. So, if you go through, I'd say about 50% of the founders who've really taken their business and done something with it and never stepped foot in the industry prior to their first company. So I think we have enough experience with founders to know that, it's probably as much as an advantage to have not been in the industry than it is to have been in the industry, I guess is the way you might look at it.
I
It's
also
just,
also think when there is experience there, it tends to lead to higher valuations. And at the early stage, like one
Yeah.
of the things that we look for is a proper trajectory for the valuation of the business.
Yeah.
I think a lot of times stuff can get overvalued or overhyped in the beginning, and just it creates something that we talk a lot about, which is, we're hunting a particular return profile, and when you start to pay too high a price from the very beginning, knowing that the kind of dilution that's coming in this industry, you just have to account for what you want your target ownership and what your return profile to look like from the very beginning, and so when you're starting in a place where it's overvalued just from where the business is, regardless of the experience that's around the table that's supposed to mitigate the risk, for us it's just less attractive. I think that in our experience, I think the other piece is there's just a trajectory that makes sense. Like if you're overvaluing the business from day one, you're playing a dangerous game, because on one level you're saying, all right, we're going to dilute a lot less now and it's going to be great. On the other end, it's like the next time you go to raise, which you're most likely going to have to in the early going, if something doesn't go as planned, which happens all the time, you're setting yourself up for a potential down round, or just to make the fund, you're going to spend a lot more time on fundraising, trying to get the next step up, so I think it's what we always try to coach is like, it's not always in your best interest to overprice yourself, and what happens is, I think when there's experience in the industry or you're drafting off of some other success, that tends to be more the case. And so it tends to make us shy away a bit more. And so I think that's what leaves the door open for folks that are maybe more reasonable in terms of where their starting point is, and maybe not coming from the industry or not having a whole ton of, credibility to stand on.
Yeah. I had a growth stage PE investor on the show a little while back, and he was talking about of how there are just so many talented food scientists, formulators out there that these days that it can obviously take a fair amount of time, but making a really good product maybe is not as defensible as it maybe used to be. And that building just a really differentiated brand is in a lot of ways really the key to building a really strong moat. And I guess whether you agree with that general premise or not, I'm kind of curious how you guys think what does a truly differentiated brand look like today in its market, and how do you know that they've carved out kind of a defensible place from a brand standpoint? Because obviously it's more than just a good looking logo and good looking packaging. So Adam, I'll let you take that one first.
yeah, I don't know. It's almost kind of category dependent too. Like you could take something like just the gummy category, right? Um, there seems to be such a surplus of these better for you or functional gummy products that I don't know, we've probably seen maybe a dozen in the past year, 18 months, in addition to all the brands that are out there in market. And it's not an exactly difficult product to go out and find a co-manufacturer to produce. Not incredibly difficult to formulate. So I feel like there should be almost more barriers to entry, but these days you can go out and contract with anyone you need to go and take a product to market, right? And I think that there's oftentimes when there's a kind of a hot trend or there's a shift in consumer preferences, you'll see the first two brands kind of come in, get entrenched a little bit, and then everybody else. There's a tidal wave of brands that come behind that. And brand will help. I think some of those companies stand out. Speed all of a sudden becomes a factor, right? So like we've looked at some opportunities of just knowing, fully acknowledging like you're not going to be able to fund off a bunch of other competitors here. You're going to have to invest in brand. You're going to have to just move through the system more quickly to try to realize, an outcome or to carve out a real kind of pole position for yourself. So I would say speed comes into consideration there, but I don't know. What do you think, Chris? Anything else?
I think speed is the biggest thing that we're going to see change in the next 10
Hmm.
years.
Yeah.
I think you see like with social media and AI major shifts happening still in retail and will continue to be happening in retail and e-com and delivery, and like we're in it every day, but when you step back and look at it, it's like things are just going to go faster and faster. That said, though, I think there's going to be a lot more noise, and so what I would recommend, and this is true going backwards as well, I see a lot of the time products get dictated by the co-packer. In other words, like you could do the formulation, you could find the co-packer. They're not creative people, and I say that lovingly, right? But like they need to be pushed to see, like they're not going to see your vision. They're going to see what they know works because if they exist as a co-man, they know what works, from their perspective. They're not, we don't know that your great idea is going to work. Right. So I think there's a big gap between kind of the formulators that you work with and the people who are actually going to produce your product. And what I see a lot of time is that conviction's not strong enough to maintain the integrity of your original idea. And so it gets diluted. And like I said, if it's not 100%, if it gets diluted to 95%, probably has less of a chance. And so yes, there's going to be access to more formulation. Yes, AI might help you formulate your product in a way that you've never heard of. All those things, but it comes down to the conviction of what you want to accomplish that I still think is going to be where the most value lives, coupled with the brand moat. Brand moat is always going to be the most important thing, I think, in this game. I think brand still matters. I think that there's good arguments to be made for brand doesn't matter as much anymore. I just don't believe that. I think where brands are so ingrained in our culture for so long that I think they're going to continue to be a really powerful moat. But, when I look at, I'm like less interested in patents and more interested in trade secrets, around formulation. So I think being really intentional from the get go and really having conviction around what you want to do. And I think, being willing to take a risk if it costs more and you change, and your strategy has to match the risk that you want to take on the formulation side. There's still a lot of the people, like as accessible as formulation and manufacturing are, the real secret sauce is in what you can create, what you can convince people to create, frankly, especially if you're talking early stage, right? And especially if you don't have credibility yet, that's the biggest opportunity as I see it.
Yep. That makes a lot of sense. On the topic of building that brand early, Adam, in my experience, like the quality that a brand and packaging design agency produces is like largely dependent on the brief that the brand actually provides. It's kind of that, I don't know, quality in, quality out, garbage in, garbage out kind of concept. And I know you ran, brand packaging agency at a pretty large scale for a while. I'm kind of curious from your perspective, what does a good quality brief look like to you in terms of what a brand puts together and delivers to that agency?
Yeah, I think it's critical. There's some firms that you could go to, some agencies you can go to, and you don't have to have a brief prepared. They're going to help you prepare a brief, right? They're going to help you to be introspective as a brand, kind of figure out what the real kind of formidable bedrock of the brand is going to be built around. But there's a good chance that you don't end up at an agency that's going to do that. And instead, it's just, open dialogue on a couple of conference calls about what you want to do with this company, where you want to go. And you're going to get some sort of kind of mixed up condensed soup back in your concept. So that's where having a brief that can focus a creative team, I think, is really instrumental, is just being very diligent about that. I think that if the founder can create it themselves to start, and then the firm, the agency, can help refine that and almost kind of translate the intended spirit and meaning that the founder has put in their brief into something that's going to work and resonate really well with consumers out in the marketplace, accounting for all the other brand signals and brand stories and narratives that are out there. I think agencies are really an interpreter between a founder's vision and idea and what is actually going to resonate with consumers out in the marketplace. I think that's the greatest strength of hiring a firm outside of getting, design work that you couldn't do yourself.
Yeah. No, that makes a lot of sense, actually. Chris, a bit of a different side. I know, you spent a lot of time at Dirty Hands, which you can give a bit of quick overview what that is too if you want. But I'm kind of curious, that experience, how does that impact advice that you give in terms of having a really strong ground game and where to focus and how to get the most out of your dollars?
Yeah, Dirty Hands is a full service merchandising company, and they focus on final mile execution with full time people. So in other words, people that have relationships at store level that can get stuff done. Whether it's optimizing shelf or packing out product and solving out of stocks or expanding your space or driving end caps, like things like that, right? That every day when you show up and do those things, they move the needle. And it was before spending 6 years helping grow that business, I was on the brand building side myself. And part of what led me to that was running a brand that grew really fast and realizing how hard it was to execute. When you're running through broadliner distributors and you don't have any visibility and you don't know where you are on the shelf or if you're in the back, stuck in the back room or whatever it may be, I really got obsessed with wanting to learn about the final mile execution side of brand building because I would consider it brand building. And you look at some of the best companies in the world, like the Pepsis and the Frito-Lays and these DSDs that own the shelf, right? Like when you think about like the impact of a DSD, it's like when you're in charge of reordering the product, not the store. Like that's the ultimate to me, because you're kind of controlling the space, the real estate, and obviously that works well when you have brands that sell really well. That's what motivates the distributor to do the work and sell in product is when you've got something that moves exceptionally well. And so we called ourselves DSD without the trucks, but for me, because DSD doesn't exist in the same way in natural channel that it does in conventional channel. Pepsi's not necessarily, operated as a DSD within some of these natural accounts. And so for me, I had the luxury of working with over 1,000 brands in that time frame, cross category, and I just really learned a lot. It was really going to school and then also just networking with so many of the people that were building this most successful playbooks for the highest velocity, most successful brands. And so, what I realized is like, and if you don't have that execution lined up, you're missing sales, but I also think it's just the exposure to what the game actually looks like at an intimate level day in and day out over the course of years.
Yeah.
I realize now as being on the investor side of just how big of an advantage that is when you're looking at brands and evaluating brands. But I think it's something that we try to share as much as possible, our experience, with founders. We try to leverage the network and the capability and the access and all of those things to help give them an edge. But, I think it's a massive thing. If you're building a brand in CPG, in retail, especially, understanding how your product's going to show up every day is a big part of the game. And that's part of why I hate door count as a metric, because I know from firsthand experience that more doors means more resources that you have to, to drive velocity and kind of show up in a retailer successfully. So my best advice to founders is start in a small footprint, optimize your performance and your velocity and build that relationship. And once you feel like that's really solid, and then you think about expanding that, and I know it's easier said than done with things like MOQs and other factors that entrepreneurs are facing. But really, if you're not working in one of the doors you're in, you need to fix that before you expand.
Yeah, totally. Last question for you guys. Last kind of two questions for these earlier stage founders that are actively raising. You interact with so many of these on a day-to-day basis. Or they're about to start raising in today's market. What does a really dialed in fundraising process look like? And then on the other side, what are the most common ways that you see founders really shooting themselves in the foot along the way in this process?
Yeah. So what a dialed in process looks like, I could speak to this a little bit because Chris and I have been fundraising for the past, 8 months or so, 6 months for Supernatural. But I think it's one, keeping, a good CRM in place, right? So you're gonna create a lot of contact, and I think that the next best thing to a yes is a fast no. Just getting to know where you stand very quickly with investors, but always updating like your CRM or your tractor with where you are in the conversation, who needs followed up with, who gets the phone call, who gets the text, or who gets put on the email update list, right? And I even think like a founder kind of keeping tabs on everybody in a CRM. And even if you get ghosted, or even if you get put on pause or you get a rejection, a decline, still worth keeping those people up to date on the developments of the business, on the development of the fundraise, presenting, the business to them through something that's not too obtrusive, like an email update. You never know when somebody kind of catches a wild hair up their nose and decides that, you know what, I'm gonna circle back around with this founder, I'm gonna get it, or they're gonna forward that email newsletter to, to somebody who they think it might be a fit for. So I think that's half of it. It's just keeping track of conversations and just deploying the right follow-up protocol in a timely fashion. And, there's all these other little things too, is you want to create a little FOMO. It's about, shooting all your shots at once. I like the strategy of going and saying, all right, if I've got 20 investors I want to reach out to, my approach would be, let me find the bottom 5 that if I sign them, it'd be a miracle, or, I'm maybe indifferent. And let me run batting practice with them, kind of take your C and D accounts and kind of run through your presentation with them, and work your way up to your critical prospects. But
I think the biggest mistake that you can make is, and I used to do this when I was younger, you have money, I need money, give me money. Doesn't that make sense? It's like, don't start in a transactional place, I think is the biggest thing. And I can't tell you how many incoming messages come in through LinkedIn every time I want to repost it, because it just drives me crazy. But like, would you be interested in this? I've never met you. And, quick, like, hey, it's not really on our thesis. Well, do you have anybody in your network that you could connect me to? I don't know you. I'm not going to connect you to my network. Like, if you approach fundraising from a transactional perspective, you're going to waste your time more importantly than other people, and so it's just a waste of time. So I think that the biggest thing is this is what I like to say. And as Adam said, we're fundraising right now for ourselves, but our approach is really, and I genuinely mean this. Most people are like, I hate fundraising. If that's your approach, you're not going to be good at it.
Right.
I really genuinely like fundraising. And the reason is because I get to meet so many cool people. Some of our LPs that I didn't know before we started this process are literally becoming really, really good friends, and I think that that's the way that, fundraising, I like to say fundraising is an opportunity. And it's because of that reason. It literally is a time in your life. It's a span of time. It's always going to take longer than you think. But if you approach it in an organic way where you're just searching for alignment, if you believe in what you're doing, you're sharing what you're doing. If somebody has alignment and responds to that and also is interested in and believes in that with you, there's going to be an alignment, and it's going to happen really organically. And if you're trying to force that just to get the dollars in, a lot of times the worst case scenario is that somebody does write you a check and it's not a good fit and there's not alignment, and that can lead to a lot of disruption later. And so I think that you need to be thinking about, okay, not only is this an opportunity to meet amazing people who I can find alignment with, but then I think from there, the more that you build your investor base, the more those are going to be the people that are going to be most likely to help you, not just complete your raise because they've got friends and networks themselves, but also add value to your business. And then, when you want to do the next raise, they're most likely going to be the ones to step up and help you fill that round. And they're also going to be the most, after you exit your business successfully, they're also going to be the investor base that is most likely to invest in you again. So I think if you just take the long view in terms of how you're approaching your raise, I think it's going to put you in a position of approaching it much differently and much less transactionally. And that's the biggest mistake I see, is treating it that way versus looking at it positively and in the long-term view, how impactful this process can be to your network, your life, your business, not just what you're trying to accomplish from I need this to grow X, but from a personal development perspective.
Yep. Man, that's really helpful too. Hey guys, this has been great. Really appreciate the time. I know we're getting over an hour here, but yeah, what's the best place to follow along with you guys, like both personally, and then best place for both, I guess, founders and investors to follow along with Angel Group, and then also Supernatural as well?
Yes, Angel Group, our teammate Emily Morgan, she does a pretty good job of keeping us active and posting on there. And I know she's in the DMs a lot with some of our friends and followers. So that's always a good place to get in touch. We are theangelgroup.com, our handles. That's our website handle. There's a form there where brands want to take the plunge and submit their information for review for consideration to present to our syndicate. There's a form there. We always recommend just kind of reaching out personally, either to Chris, Maddie Serviente, or myself via email. I don't put my email out there too liberally, but if you can find it, you can email us. And then I would say LinkedIn too is always a great place to connect.
Perfect. How about,
Yeah, and Supernatural. What's our URL, Chris? Do you remember?
Supernatural.ventures.
Yeah, I think that's right.
I think that's right.
Yeah, it
I'll confirm and
that should get you to the right
I'll put
place.
the right one in the notes and confirm it for you.
Yeah, for sure. I think we're trying to be pretty approachable, but if you're going to come at us authentically and don't
be prepared.
Don't come at us transactional.
Yeah, for sure. Awesome, guys. Appreciate the time. This has been great. Yeah, thanks for coming on.